Hi traders, welcome to Market Outlook, Trends, Risk Events and Trade Setups, brought to you by Vantage Markets. This is a weekly webinar where we focus on the key events that have been happening in markets and are about to happen in the week ahead. So before I get to it, let's just bring up the disclaimer, which you can see, which I just have to let you have a read of. And then we'll just run through what we hope to get through in the next 30 minutes or so. And we'll just follow the normal format. So we'll just check out some of the themes, major themes, of course, going through markets at the moment, running across markets. We'll look at stocks initially, and just the Bank of America survey, interesting survey, and just this turnaround in what we've been seeing with European stocks versus US stocks. And we'll just use those few charts actually that we used last week as well, but just to run through those again and really highlight this theme that we've been seeing in this first quarter of 2025. If I just have, just run through, so the main topics for the next 30 minutes or so, we'll just check out how markets are shaping currently. As we do, we'll look at those themes and then stocks as well, and the technicals around the main indices, before then looking at the three central bank meetings last week, of course, and just running through the dollar index. We'll look at dollar yen as well, and then the UK Bank of England meeting, of course. We then will look at this week's main events, which include basically price pressure data, prices data, really, core PCE out of the US, as well as UK CPI data. We get the spring statement from the UK Chancellor as well, getting some attention. Whether that really has a massive impact on markets, I'm not sure. But we do get other CPI data out of Australia and Tokyo, which we will hopefully get to as well. And we'll look at all the main currency pairs associated with that, those data points. So first up, really, just a couple of charts. We showed you this earlier, just before we get last week actually, but just before we get to that, markets at the moment. US stock futures firmly in the green. Euro Stoxx 600 began the week on a firmer note actually, before trimming gains, opening gains after a mixed, really Asian handover. Interesting, we did get PMI data out this morning. Eurozone flash data that showed cautious further improvement, really up to 50.4 from 50.2 in February. Most notably, the manufacturing PMI actually soared ahead of a possible further escalation of the trade war, of course, next week. For the first quarter, though, this means that a positive GDP growth print is likely after stagnation at the end of last year in the Eurozone. The dollar index, that's lower after some choppy price action in early European trade. And the macro narrative really for the US has kicked off this week with a focus, of course, on the trade agenda and Liberation Day next week. Yes, just getting into that then. Interesting, over the weekend, President Trump, he reportedly plans his tariff liberation day with a more targeted push, essentially. That's according to Bloomberg, citing officials, while it was noted that Trump will announce widespread reciprocal tariffs on nations or blocs, but is set to exclude some, and the administration is currently not planning separate sectoral specific tariffs to be unveiled at the same event as Trump had once signaled. So those were meant to be on car making, semis, pharma, and then of course on the EU, Asia and China. But there is now some pullback actually in that messaging. Wall Street Journal also reported actually that the White House will narrow the April 2nd tariffs, and that tariffs, as I've just mentioned, actually on those industrial sectors such as cars, microchips, are no longer expected to be announced, although major trading partners will still be hit with reciprocal tariffs. So really, we said this in our week ahead, actually, just about potentially these conflicting signals we're getting from a lot of these announcements from the Trump administration, kind of signals that there is some disagreement within the administration between officials, and that's why we're getting such a chaotic announcement of these different levies, tariffs, and other actions that they're taking on. So that's to look forward to. Obviously, April 2nd is the key date. April 1st is when I think Trump sees the reports, the investigations, and then decides what to do going forward. Very likely there's going to be some sort of delays. There'll be deals cut, and potentially, obviously, we'll get a lot of speculation going into that date next week. Otherwise, Russia-Ukraine indirect peace talks, they will be on markets' radars. Of course, the latest developments suggest some improvement, but provide really no clear indication that the immediate ceasefire is really on the cards. Market optimism on that really, which showed through some European FX underperformance last week, really sees risks being scaled a bit further unless there is tangible progress in this week's talks. That's sort of the bottom line from the Russia-Ukraine negotiations. As for stocks, well, we mentioned this Bank of America survey last week that is basically showing you the biggest investors and money managers on the globe, actually, and that showed the biggest switch on record by fund managers out of the US over the last 4 weeks. And as with prices themselves, really, the turn, when it's come, has been really quite sudden and dramatic and really not predicted by anyone, really. Very, very few people predicted European stocks doing so well, US stocks not so well. So that exodus into Europe and emerging markets as well, although not Japan, has been pretty extraordinary. The fastest weekly shift on record, really, and cash finding a home in previously neglected markets. So the Euro Stoxx 600, that's showing probably a gain of around over 9% for the first quarter. That's against the S&P's 4.5% loss. And that would be its strongest performance against US benchmark in the first 12 weeks of the year since 2015, so 10 years. Just a couple of charts really that show you world stocks really against the US, and yes, heading for their best quarter since 2019. I think, as Reuters put it, they kind of said move over TINA, which means TINA. There is no alternative. Investors really considering what they call tiaras. So there is a real alternative to US stocks. Just a couple of charts, as I say, S&P relative to the MSCI All World, and you can just see that big sharp fall and below the 200-day moving average. So shifting away from US exceptionalism. Again, you've got the Mag 7 here actually relative to the DAX, and you can just see that huge tumble from just before the start of this year. And then this survey that I mentioned, and then just this big record drop in US stock allocation really between these global fund managers, the biggest, as I say, managing money. And you can just see the red line, a red bar really is out of US equities and then into, well, Eurozone, UK, EM, and also cash. So just that huge record drop in shifting of allocation of equities. Just before we get onto that, then let's just have a quick look at a couple of the stock indices. Firstly, you've got the S&P 500 weekly here. Interestingly, it did snap its 4-week losing streak. It was up 0.5% last week. NASDAQ as well, similar really. And the rise came actually, interestingly, in spite of some gloomy earnings from FedEx, really. FedEx seen as a sort of bellwether for the economy going forward, the US, and that slid 6.5% after it lowered its forecast, blaming persistent weakness and uncertainty in the US industrial economy. So interesting read from them. Nike as well, that dropped 5.5% after warning it expected sales to decline, citing tariffs and falling consumer confidence. So will be interesting. We do get consumer confidence out of the US out tomorrow, I think, and then some data on Friday, as well as that core PCE data. We get personal spending and income. So just watch out for those as just signs of whether it's highlighting again this falling, as I say, consumer sentiment that some firms are citing and potentially may kick in with the tariff uncertainty. Just on the technicals, then you can see this weekly chart, 4 weeks down, and then obviously this changing that tide slightly. This is the weekly chart, so you can just see we tapped a really long-term level from the low in October 2022 up to the record high, just the minor fib level 23.6 of 55.20. That's on the weekly, and you can just see we broke out of this ascending bull channel. So it'll be interesting whether we can get anywhere near that above. If we move on to the daily and these smaller near-term fib levels again, let's just pull it back a touch. Again, break out of the bear channel. The black line is the 200-day moving average, and you've got the blue line, which is the 50-day moving average. Interesting, that is falling potentially through that, which would be a death cross, I believe. So bearish, a bearish price pattern essentially. And we've just got some near-term fib levels in here from that August low up to the record highs. So we're just on the halfway point of that move. That's at 56.33. Upside, is the 200-day moving average and the 50-day, and then the 38.2, which is at 57.54. And then we've got that long-term fib level, which acted as support. But below that, if we do lose that, then probably these swing lows from September of last year around just above 5,400. So interesting levels for the S&P, whether this is just a dead cat bounce and we move and roll over, or whether we can push up towards the 200-day moving average and that 38.2 fib level, as I say, at 57.54. The NASDAQ, similarly, now the 50-day is moving through that 200-day moving average. So that's interesting, whether then that signals then more downside to come. You can just see, I'll just pull this back. I've got long-term fib levels again, and then that 23.6 from that levels at 19,442. Otherwise, a closer fib level is where we found support around 19,264, and then just above that, the halfway point, which could cap the upside. You can see it did so last week. That's at 829. Just on the Dow. So we're just tapping now the 200-day moving average. That's at 42.042. Otherwise, then above that, you've got 42.562, that fib level, and then the 50-day moving average just below that of 42.449. Otherwise, 41,000 just around there is looks like decent support. Okay, that's stocks. Let's now go to last week's main events. Of course, the central bank meetings. First of all, the Fed, of course, we used this before, but just updated it really. The graphic where the Fed left policy unchanged, of course, at its meeting last week at 4.25% to 4.5%. Powell basically sent a message pretty much as balanced as it could be. So he wasn't downplaying any downside risks, but he also emphasized that the Fed is not in a hurry to move, pretty much as was expected. We did get the Fed's updated forecast, which pointed, as we again highlighted last week, to stagflation risks. So growth was revised lower to 1.7% this year from 2.1%. And the economy actually will no longer expand above potential, which is 1.8% in the years after. Inflation, though, got a bump up mainly for this year, 2.7% headline PCE, 2.8% core amid import tariffs. Powell, again, he said these cost push factors were probably, he actually called them transitory, can you believe? But in a higher inflation environment compared to Trump's first term, of course, lots of economists are really not so sure about that. Bottom line, really, uncertainty is on growth. The unemployment rate and the PCE forecast is very high, really, and risks are skewed to the downside for growth, of course, and then to the upside potentially for the other two, so unemployment and the PCE forecasts. Median rate forecasts, anyway, they were unchanged for now. So 2 cuts this year and in 2026, and then 1 more in 2027. This all triggered a relief rally actually in US Treasuries. And then during the press conference, Powell still held really an optimistic view, which probably didn't really capture the forecast narrative. So he noted weakness in soft indicators, but these are not yet filtering through into hard data. And that's why they are happy to go slow, really, and not in a hurry to move. And it's really not until they do move that the Fed then would potentially reprioritize growth over inflation. Yeah, money market expectations, they also stayed broadly unchanged with a full cut not priced really until around July, actually, fully priced, actually, and stocks like that actually, and jumped up to, well, 1.4% the Nasdaq on the day, while the dollar retreated from intraday highs. You can just see there then, it's around 70 basis points or so of easing priced in now for the Fed. So that implies certainly 2 fully discounted 25 basis point cuts, and really then the high chances of a third above 80%. Yeah, so more than the current dot plot implies, of course, which is interesting, of course, with tariffs and inflation expectations as well. Just before we get to that, we'll just look at the dollar index chart, sorry, and just highlighting this graphic that we just showed you. If we just move on now to the DXY chart. Which I'll just show you is here. So where are we? We're consolidating around the lows for us at the moment. We've got this 61.8 fib level of this September rally. That's a 103.98. So we're just around that level. Again, really interesting. I just want to double check this. It's actually the 21-day moving average. But still, it's a shorter time frame average, and we are moving through the 200-day. If I just put on the 50-day, we're still well above that, but that is moving down through the 100-day. Okay, apologies for that. And I just want to double check if that is the case. So no, we're well above, but we're moving through the 100-day moving average. Possibly bearish sign, but it's more important when it's the 200-day. So we're just, yeah, consolidating around the lows. Yeah, we have to get above probably 104.94, which is a 200-day moving average, and then the halfway point of this September rally is at 105.16. So that's for the dollar. Otherwise, strong support just above 103 in the low 103s. Not too much data, and we'll go through that shortly this week. But yeah, a lot of focus, of course, on April 2nd and that date. Okay, we also had the Bank of Japan meeting. If I pull up dollar yen, and you can just see we're just trying to possibly break out of this downtrend, this bear channel, if you like. The Bank of Japan, they left policy the rate unchanged at 0.5%, but the meeting was probably more hawkish than expected, actually. The domestic economy is continuing a gradual improving trend. Price consumption has been on a moderate increasing trend as well, despite the impact of price rises and other factors, as is business fixed investment. So CPI inflation ex fresh food has kind of been in the range of 3 to 3.5%. Amid rising services prices, that's basically wage increases, of course, and a rollback of government energy measures. The BOJ does expect the economy to keep growing above potential, of course, with overseas economies continuing to grow moderately, and this sort of virtual cycle from income to spending gradually intensifying. Underlying CPI is likely to be at a level that is generally consistent with target. But the bank did highlight, of course, international developments regarding trade as a big important risk to the outlook. Otherwise, domestic developments do seem to suggest a gradual normalization of policy, with the BOJ ready to adapt to the timing to cope with, of course, that international uncertainty. Next Bank of Japan meeting is May the 1st. So yeah, slightly more hawkish than expected. Didn't really help dollar yen too much, or the yen too much. You can just see there we moved lower on the day, but then we've had 3 consecutive days moving higher. If I just pull up the 10-year yield, which is very highly correlated with dollar yen, you can just see an uptick, a bounce off the 200-day moving average at 4.22%. That's a 10-year yield in the US, the Treasury. And so just watch that, whether we find some resistance around sort of 4.3%, just above there, where we're trading. And it'd be interesting whether we could break through that or not. That's on the Treasury yield. So if we do break through that and go higher on those yields, then potentially dollar yen will go higher and can decisively break out of this short-term bear channel. Upside levels 150, 150, and again that's where the 200-day and 50-day moving average actually is. And you can just see actually on this, yeah, the 50-day potentially moving down through the 200-day moving average, which would be potentially a bearish signal. It doesn't look like that at the moment, but we can easily roll over. So support, near-term support, probably is the halfway point of this September move at around 149.22. Otherwise, stronger support around 146.94. Okay, moving on to the Bank of England meeting. Just again, a quick review and a graphic updated. Yeah, they kept rates unchanged as expected, 4.5%. Slightly hawkish vote though, 8-1 versus 7-2 expected. So just one voting for a cut, Dingra for a 25 basis point cut, whereas Mann, who had voted for a 50 basis point cut last time, sided with the majority. The central bank, basically, Bank of England maintained its previous guidance, noting that monetary policy will need to remain restrictive until risks to inflation returning to the 2% level have dissipated. Although the vote split was, as I said, like slightly to the hawkish side, nothing indicated a broad, real shift in sentiment within the MPC. So gradual and careful approach to rate cuts, with the next 25 basis point cut probably likely in May. And then that would mean, well, you can see here markets pricing in another couple of cuts potentially as well. That would take the bank rate down to 3.75% by the end of the year. That's money markets pretty much predicting that. Yeah, around a 60% chance of a third cut, which, as I say, would take it down to 3.75%. That said, many economists have previously highlighted that the risks have been skewed towards, well, a swifter cutting cycle in 2025, but possibly that could be more balanced now, that risk picture, as the Bank of England just citing sort of inflation risks as well. We did get the jobs report, actually, just to mention, out of the UK last week as well. Wage growth still elevated at 5.9%. The jobless rate remained at 4.4%, although there's statistical issues with that data. And really, the numbers really supported and do support the Bank of England's gradual approach to easing monetary conditions. Okay, also just briefly, we had Aussie jobs data, actually, that fell quite sharply by 52,800, consensus expecting 30,000 of growth. Also, January numbers were revised lower. Just looking at those numbers, actually, the unemployment rate stabilized at 4.1, but that was mainly because of a big setback in the participation rate. Interesting, was a very weak number, but shouldn't really derail their plans for the RBA, that is, for gradual rather than consecutive rate cuts. Money markets still bank on a status quo at the next meeting on April the 1st, I believe. Okay, moving on to this week then. We have, as I say, price data really out of the UK and the US, firstly. So if we just look at core PCE data, that's out of the US on Friday. I mentioned we do get other personal spending and income data as well. But for the PCE, the median headline is, I think, expected at 0.3%, and then year on year 2.5%. And the core number, that's the key number, that's expected also at 0.3%, and year on year 2.7%. For your guide, CPI headline was 0.2%, so lower than the 0.3%, and the prior was 0.5%, while the core was also 0.2%, actually expected 0.3%, and the prior 0.4%. PPI also, which feeds into this PCE data, that was unchanged, actually, and the core eased to negative 0.1%. So as we just said, really, the Fed last week, they lifted their expectations for PCE, projecting it would end at 2.7%. That's up from the previous forecast of 2.5%, and of course above the 2% annual target. Powell, of course, he signaled for the Fed will wait for more clarity on Trump administration policies, as it really assesses when to potentially resume rate cuts. Money markets, they are pricing in around 21 basis points for the June meeting, so nearly fully priced, with the first, fully priced cut actually in July. And then, as I showed you, around 70 basis points priced throughout this year. So around an 80% chance actually of a third rate cut, as we've talked about. Okay, that's core PCE. Otherwise, in the UK, let's just pull up that cable chart. Just 1 second while I get the cable chart up. So for UK investors, we do have, we're about to discover whether weak growth and unexpectedly high borrowing have blown basically the government's budget goals far enough off course actually for markets to call for a return to austerity measures. We get the spring statement from Chancellor Reeve on Wednesday, and then also the OBR, so the Office for Budget Responsibility, is expected to reduce forecasts that back in October, of course, assumed the government would just meet its self-imposed spending rules. The IFS, that's another Institute for Fiscal Studies, essentially has warned that even a minor OBR downgrade would force Chancellor Reeves to choose between tax increases, spending cuts, or potentially months of damaging speculation about what she will do in the autumn budget. Long-term UK debt costs set by gilt markets are around 15 basis points below January's multi-decade highs after Labour's welfare cut pledges, but bond investors are on high alert, of course, for a rule breach that the government cannot fix. Bottom line, really, spending cuts should be enough to meet this fiscal rule, but of course the gilt market, because of that trust implosion a couple of years ago, will be on the lookout, of course, for any missteps in the very tight room for fiscal manoeuvring, and the bar for a negative reaction, either in bonds or a meaningful repricing. Lowering growth expectations both have the potential for a negative impact on sterling. So that's the spring budget. Otherwise, we do get CPI data actually out on Wednesday as well. Expectations for that. Headline to slip to 2.9% from 3%, and the core to tick lower to 3.6 from 3.7. As a reminder, the year-on-year number rose to 3%, which was the highest annual rate since March of last year. That was from 2.5%, and the core picked up to 3.7 from 3.2, while services, that jumped to 5% from 4.4, although it was below the MPC forecast. This time around, services inflation possibly ticking up to 5.1%. Really, though, I think a lot of economists think this upcoming release will be the calm before the storm of price resets, with inflation set to rise to 3.5% in April. So just beware of that, and that is known that we will carry on going higher in inflation, and this is what is causing the Bank of England to very much be gradual in their rate cutting cycle. As for cable, you can just see we're clinging on to the 61.8 of this September downtrend. That's a 129.24. We have had resistance around 30, so tough to beat at the moment. Otherwise, if we do fall back, then you've got the 200-day moving average at 127.98. And then the next fib level, the halfway point of this September move down at 127.66. Okay, just also we have Aussie CPI data out this week as well. Price is really expected to have held steady in February. And again, that should support the still cautious RBA, really their patient approach to future rate cuts. Just on the Aussie dollar, you can just see we're clinging onto the 50-day moving average at 62.88. If we lose that, then we probably go down to the swing lows from March around 61.86. And then you've got that very prominent swing low from late 2023. That's at 61.69. So interesting levels here with resistance just above around, well, just below 64 in the Aussie. I mentioned we also get Tokyo inflation data. That's due on Friday, as the Bank of Japan, as I mentioned, continues to monitor mounting domestic price pressures that could warrant, of course, more tightening. Governor Ueda, I should say, suggested the central bank could deliver another hike even before the dust settles even on the impact of US tariffs. Okay, we will wrap it up there. A quick half an hour or so. Thank you so much for following us and listening to us for the last half hour. And please do follow us on social media. Busy time in the build up to this April 2nd date, of course, and Liberation Day, as Trump's calling it. We shall see. Watch out for a lot of speculation in the build up to that. And of course, some interesting CPI data as well coming out this week. Take care, and we will speak to you same time next week.